Hi, welcome to my class. My today's topic is about corporate securities under securities form of investment. In the previous classes, I have explained about the government securities, about treasury bill and dated bonds. Let me explain about the corporate securities. The corporate securities are the securities issued by private and public companies, whether listed or unlisted. In another way, the securities issued by MNCs are called as a corporate securities. Here our concept is, or we are studying the corporate securities as investor, or how it is beneficial as an investor, or how it is beneficial, or how much return the investor can get, or how much it is beneficial for the investor. That is our topic. We are studying the corporate securities as an investor. So therefore here the returns in case of corporate securities are not assured. The return is not assured because risk is high. Why there is no guarantee for the return? Because risk is high. The companies may becomes insolvent at any stage. So whenever company becomes insolvent, the possibility of losing the money is high for the investor. So that's why the risk is generally high in case of corporate securities. Whenever you invest in case of corporate securities, the return possibility of return is high because risk factor is also high. So there is a return is always based on the risk factor, and the risk is of default in corporate securities. The nature of risk is default. You cannot of course there is a definitely there is a risk, and that depends upon how you will analyze the particular corporate securities. And there are a lot of securities available in case of or under the category of corporate securities. Mainly we categorize it as shares and debentures. Major two division of securities under corporate are called as shares and debentures. And issuing authorities, already I told, MNCs are the issuing authorities, private as well as public sector companies, either listed or unlisted. They have the right to issue the corporate securities. Or it means again, we are studying as an investor. As an investor, you can buy the private company securities or public company securities. Means you can invest either on private company security or on public company securities. In another way, you can invest on listed and unlisted securities issued by private or public companies. When you go for the regulatory authorities, corporate securities are regulated by Securities Contract Act. Means it is purely regulated by the SEBI. The SEBI will monitor always. It will protect the interest of the investors. Not only the SEBI, even the stock exchange, they will act in favor of the investor to protect the interest of the investor. But not a guaranteed protection, guaranteed securities. Whenever the company is in a position of insolvent, definitely they will give the information to the investor. So you must have in a position to understood, or you must have in a position to collect that particular information about your companies, on which about your securities. Next, when you go for the income tax concession, no special tax concession for corporate securities. Again, it depends on which company securities you have invested, which company security you are borrowed. On the basis of that, or on the basis of nature of the securities, whether you are invested on shares or on the debentures. The speculative gains is there. There is a possibility of speculative gains in corporate securities when they are traded in the stock exchange. Of course, these securities are traded in the stock exchange. So whenever they enter into the stock exchange, then there will be speculative dealings. In that you may get the income or you may lose the amount. So that is again depends on how you will analyze or how you understood about the stock market. So that is about the corporate security. So again here we have to study as an investor. So under corporate securities, there are two division. One is called as a shares and debentures. We call it as one is a ownership securities and another is a creditorship securities. So today I am going to explain about the one of the ownership securities about the equity shares. Before entering into the concept of equity shares, let me explain about ownership security. This is the division of corporate securities. Under corporate securities, two division, creditorship securities and ownership securities. So today I am going to explain about ownership securities. Ownership securities consist of equity stock and preferred stock. Ownership securities consist or includes equity shares and preference shares. The term ownership securities, also known as capital stock, or it represents the capital stock which represents the shares. Shares means equity as well as a preference. Shares are the most universal form of raising long-term funds from the market. Why the companies issue the shares? It is to raise the long-term funds. Every company except a company limited by guarantee has a statutory right to issue shares. So these are the meaning of ownership securities, or this is the meaning about the ownership securities. Again, we have to study as an investor, not from other point of view. How it is beneficial, what are the features includes under ownership securities, how much it is beneficial for you whenever you use your fund under ownership securities. So as like I already told, every company except a company limited by guarantee has a statutory right to issue the shares. So before buying the or before investing on shares, you can go through these all guidelines of the or these all features of the companies or about the shares. The capital of a company is divided into number of equal parts known as shares. The mainly there are two division of ownership securities, that is the equity shares and preference shares. So that's about ownership securities. So under ownership securities there are two division, equity shares and preference shares. In simple terms, ownership securities are the securities or the shares which will provide ownership rights to the investor, and such securities are called as ownership securities. So now I am going to explain about the equity shares. They are earlier known as ordinary shares, or equity shares are the most common shares under category of MNCs in private corporate securities. The holder of these shares are the real owners. If you buy the equity shares, then you are considered as a owner of the company, or means you have the some shares in that particular company. The real risk bearing shares of the company on equity shares is called as a share which we or the owner or the shareholder who bear the risk of the company. And equity shareholders control the business. They will control the business. They have the voting right to elect directors of the company, and the directors control the business. Earlier, all equity shares had equal voting rights, but after 2000, the companies to issue equity shares with different voting rights, so that you can study in detail in other concept. Here it's not required. So these are the some brief about the equity shares. It's called as ordinary shares. It has ownership right, or it has a voting rights, or it will provide direct control, or you are treated as a owner of the company. So that's all about the equity shares. The shares which provide, which is not in the form of preference, is called as equity shares. It's called as a ownership share or a common share. There are a lot of benefits are there under equity shares. Whenever you buy equity shares of any company, then it will provide lot of benefits. Again, it depends on which company equity shares you are borrowed. So let me explain the other concepts of equity shares. So let me explain the different features of ordinary shares, or what we call as the equity shares. These features are brought from the introduction of equity shares. You must know these features as an investor or as a borrower of equity shares of different companies, because you must know that how it is beneficial for you, whether even if it is mainly especially whenever you invest for the long term. It's a base for capital structure. Equity shares are the basics for capital structure. Is a one of the part of the capital structure, like debt and equity are the main part of the capital structure. So equity is one of the main part of the capital structure. It should be there in the company's capital structure. So it means it gives you more weightage. No compulsion for dividend declaration. Equity shareholders get the dividend based on the company's decision, the decision of board of directors. If they declare the dividend, then the shareholders will get the dividend. Otherwise, no compulsion, no demand from equity shareholders for dividend. And when the companies will declare the dividend, that all topic later I will explain. There is a separate unit related to dividend. So one is no compulsion for dividend declaration. That means equity shareholders should not demand for the dividend, and it depends on the board of directors. Last in queue for income distribution at the time of liquidation or at the time of insolvent, the benefits for the equity shareholders at the end. So they stand in the last person in case of income distribution, either at the time of liquidation or at the time of dividend declare or any other cases. If distribution comes whenever any parts has been distributed, or whenever the company decide to distribute anything to the shareholder, then equity shareholder comes at the end. So last in queue for repayment of capital, this comes in case of insolvent, at the time of insolvent or liquidation or any other procedure, either in case of amalgamation or mergers or any cases, the equity shareholders are last person in the queue. Next one is a preemptive right. Preemptive right means it's the right of the equity shareholders to get the new securities, new equity shares. If the company wants to issue, public issue equity shares, then equity shareholder, the company must get the permission from the equity shareholders. Preemptive right means right to get the equity shares in whenever the company makes public issue of equity shares. So before taking the decision of public issue of equity shares, the company should get the permission of a equity shareholder, consent of the equity shareholders, then only they can make public issue. Preemptive rights, additional getting of additional equity shares, or what we call as a bonus shares for the equity share, or preemptive rights before issuing it to the public. For example, if the company wants to issue 1000 equity shares to raise the fund, then they have to issue it to the equity shareholders. So that is, there are a lot of procedures, means they have the right to get the bonus shares in simple word. Suitable for gestation period. This is from the company point of view. In the big gestation period is a term during which the gestation period is a term which begins from starting of the company end on till the first earning of the company. The duration, the before first earnings, first profit of the company, before that term is called as a gestation period. For example, if the company started on 1st January 2017 and their first earning or first profit is on 1st 2021, then that to the 1st January 2017 to 1st January 2021, that duration is called as a gestation period. So these are benefits for the company, not as an investor. So you have, as an investor, you have to wait for 3 years. Or means 3 years means you have to wait in the gestation period, because you won't get any good return. After gestation period, after first profit, you may get the benefits. So that's from the company, from a company point of view, it is a benefits. No redemption, no redemption, no charge on assets, evaluation of share values by different persons, stock exchange, news channels or other medias, they will evaluate share value, and every day you will get the information about the value of your shares. Multiple benefits, you will get a dividend, bonus shares, right shares and other benefits you are going to get under equity shares. Creation of value, it will create the value or it will create the wealth for the shareholders. Public knowledge of financial information. So these are the different features of equity shares. So that's all about today's class about the ownership securities. See, about mainly I have explained about equity shares. As an investor, you can borrow the equity shares for the long term duration, or even you can trade in case of stock market, means day trading. And there is a lot of advantages, lot of benefits for the investor. Lot of benefits are there for equity shareholders, but you must analyze which company equity shares you are going to borrow, or which companies where you are going to invest, which class of equity shares, means which company's equity shares you want to buy. That is very important. Thank you very much.